we still expect the US is going to grow at 3% this year. And we still expect the Fed's going to do not just 4 hikes this year, but 4 hikes next year. So that's unchanged for my regular listeners. But it has been an interesting month and there has been a lot of information to digest. So how do we reconcile that with our view? And in particular, what's going on with tariffs and even Facebook and the regulatory issues that are occurring there. So let's go back one step to the view. What could change that view? The number one thing that's going to change our view is a tightening in financial conditions that would slow the economy going forward. And the number one way that we're going to see a tightening in financial conditions is a sharp fall in the equity market. So for us to change our view, we have to see a fall in the equity market, something of the order of 20% from its highs. That's the sort of number we're looking at that would see the Fed start to change its growth outlook and start to reconsider its rate hikes. Absent that, we feel very confident. So, could we have a 20% fall in the equity market? Up until 3 weeks ago, we thought, yes, that could possibly happen, and it would happen because bond yields were rising too quickly. But March has given us a reprieve on bond yields, well before the tariffs indeed came to the fore. March's reprieve came because average hourly earnings, the wages story in the US, didn't accelerate at the start of the month, and the inflation story didn't accelerate. So we've had a breather in the US on inflation and wages, and that breather now will probably create a 2 or 3 month window where bonds are probably going to consolidate and would have normally given the equity market time to go up. But at the end of the month, we've had this tariff war break out. Now, the problem with the tariff war is you don't know what the answer is. Only Trump and Xi are going to be able to work this out, and only they can decide when to stop escalating. Takes me back to the European crisis when we were trying to get a resolution for Greece, and it was up to the so-called Troika to work out what they would accept. When you're trying to look at that from a market perspective, you don't know what day they're going to work it out and how far they're going to get on agreement. So we're just going to have volatility from that source for some time to come, probably 3 months. We've got President Xi speaking tomorrow night. We'll see if he offers an olive branch. But what Trump doesn't really understand, I don't think, with the Chinese is it's very important to save face, and they've got a long game. In fact, they think that's their strength right now. They think Trump has to get a solution before the midterm elections in November, whereas they can sit back and ride this out and they've got the money to do it. So I am quite concerned we're going to get an escalation in this and we're going to get quite a bit of noise coming from the tariffs. At the moment, it's not material in terms of the economic impact. The tariffs to date, the $50 billion that we saw from Trump would take maybe 0.2% off Chinese GDP if it was put in place. Maybe we times that by 3 and it starts to get material if the next 100 billion comes through. But what we really have to watch out for if the Chinese turn around and start selling their treasuries. They own 1.3 trillion. That could certainly send yields a lot higher. So we're getting to the stage now where that's starting to be muted. It's going to be discussed and we're going to have a lot of volatility. So what do we do from here? Well, the correct course is to stay focused on what we know, which is that US growth is going to stay strong absent a tightening in financial conditions. We know we've got the tax cuts there to support growth at the end of the year, and this is going to keep the Fed engaged. So we still believe 4 hikes this year and 4 hikes next year. But of course, we have some uncertainty. So at a portfolio level, we add some hedges. If the equity market falls sharply, we believe we'll have the portfolio protected. And if it doesn't happen, we'll monetize our medium-term view.